is navigating real estate property changes during COVID-19. Of course, COVID-19 is this special time that made us connecting this way, and we hope that it's actually turned out to be a pretty cool way to get connected. And I will start sharing our webinar slides with you. The reason we share the slides, we want you to see what is coming up, and also reminding ourselves that these are the items we want to cover. So first of all, we want to say that webinar is a free communication we offer to people we care. And we offer to people who needed the knowledge and wanted to learn from us. And it is not a legal advice, and it is not something that you can put responsibility to. So take that as you see fit. And we're here sincerely helping you, and we want you to know your responsibility, and we also know our responsibility as well. And speaker information, this is me. My name is Ying Sa, and I serve on National Taxpayer Advocacy Panel. It is a federal advisory committee to advise IRS, and I'm also the CEO of Community CPA, and last year I wrote this book, and I really should have already finished the second book, but I didn't. But this is the first one, and I invite you to go on Amazon to purchase this book. It is called Starting Up a Business. If you're thinking of starting, if you are going to be a new real estate agent, this is the book. On page 112, that gives you some ideas. All right, another speaker, my guest speaker, David Young, and he's here with me. And David, give a little bit brief bio of yourself to everyone join us on the webinar, please.
Hey Yang, thank you for having me on.
Very welcome.
Hey everybody, thanks for tuning into the webinar today. So a little bit of information about me. My name is David Yang. I am the broker and CEO of Home Sellers. We are a local real estate company here in the Twin Cities. More about me, I've been in real estate for almost a decade now, and I started off in the real estate investment market, and then from there moved on to the residential, getting licensed, and recently opening up the brokerage that you see now. Okay, and what we do is we help people buy, sell, invest, build, and pretty much anything that has to do with real estate. That's what we tend to cater to people, to be a one-stop shop for them. Okay, so that's a little bit of information about me, and hopefully you guys get to take away some good key points about what's going on right now in the real estate market. And we have Yang here as well to help us figure out the tax side of it as well.
So today, what we're gonna do is whatever David is talking about on the real estate side, I will plug in to give you the tax side of saving, tax side of efficiency, and the jargons that you heard and you don't understand, this time you will. And I'll make it really simple, and that's my specialty. And I like to make complex matters simple. And wouldn't we want that for life? And that's my whole life quest, to make sure that people who are with me understand what we're trying to do. And we all understand this time. This time is very unpredictable. COVID-19 is not something comes and it's gonna go in 2 weeks. COVID-19 changed the way we live. It has literally changed you. That's why you are here. I bet you before COVID-19, you were not here for webinars, but now why are you here? Because COVID-19 made you change the way you are learning. So the same with everything else, it changes. So on the real estate side, obviously changed. That's why we want David to tell us about in detail what changed. But the reason we want to understand change is not because we want to scare ourselves. Of course, I don't like change. And I like to go to the same place, do the same thing. And I felt like that would give me the maximum enjoyment, knowing my life is pretty content. Change is always going to put you on the edge of thinking. People think more. And if you're a real entrepreneur, if you have drive to do better for tomorrow, you should welcome change. It doesn't matter how it come about. Maybe you just fall off the cliff by accident. You change your life, but that's the way to change. So we all fall off cliff recently because of COVID-19, but we will adapt to it, and this is the way to learn. And I will have David talk about the changes on the real estate side. And for me, I will say to you that don't be afraid of change. Embrace it like you're hugging that change. And we can't hug each other anymore, so might as well hugging opportunities. What do you think, David?
Yes. So Ying brings up a good point. You know, there's a lot of changes going on right now, and you don't want to be afraid of change. What you want to do is you want to position yourself so that whatever change happens, you are in a position to take advantage of whatever's going on in the market, whether it's going up, down, sideways. Especially, like I said, I come from a real estate investment background, and I assume that on here today is a lot of business-minded people. You know, we're looking to how to make money in any type of market. So hopefully, what I talk about here today will shed some insight on that. So there's a few topics that I wanted to talk about. Obviously, real estate it's a vast financial sector, and we can't cover all of real estate in one webinar session today. So I'm just really gonna touch on a few key subjects that will help people understand what's going on maybe closer to home for you. So that way you can kind of gauge if the market's going the direction you like, or maybe kind of help you plan and prepare for the future, okay? So generally the three things that we'll be talking about today is gonna be the residential market, what's going on with buyers and sellers, and then we're gonna touch a little bit on the investment market, what's going on if you're a landlord, a flipper, those types of things. And then the last portion is if you are a real estate professional, we want to talk a little bit about different resources that you might have, or if you're thinking about becoming a real estate professional, then what kind of resources you have that will be able to help you as well. So jumping into it, first thing that we're going to talk about is the residential market. What's going on right now with, you know, regular home buyers and sellers, okay? So first thing that people always want to know is, where are the house prices going? Are they going to go up? Are they going to go down? Are they going to go sideways? You know, where are they going? So Yang, if you could let me share my screen, I'm going to show us some slides here. Okay, so whenever you're ready.
I'm ready.
Okay. So there's some tools that are available to everybody. This one comes to us from Showing Time. It's one of our tools that we use to schedule homes, so that way we can take our clients to go, you know, see the homes. But this is actually available to everybody. If you have internet access, you can go to showingtime.com/impact of coronavirus, and this actually shows you by state, you know, how showings are going. And the reason why showings are important is because generally there's a certain amount of showings that needs to happen before a home you know, gets sold. So this is kind of how one of the metrics we use to measure, you know, what's going on with that, okay? And you can see here the yellow line or the orange line, whatever, you know, whatever color you think it is, it's 2020, and the 2019 is the blue, or it might be black. I have bad vision of colors. So you can see right about this point right here, March 19th, that's when we had the major change, okay? That's roughly around when most states started closing. And as you can see here, you know, at the bottom of it, roughly around April 3rd, April 4th, around that time, around Easter timeframe, that's when we really hit the bottom for showings. We were about, you know, a little over almost 11% change from you know, where we should have been compared to last year. At the same time, we were 73%. But what does all these numbers mean to us, right? This just means that there's a lot less people going out looking at houses. And obviously, because, you know, most of the states are shut down, people aren't comfortable going outside because of the virus and things like that. But if we look at it further, we're starting to rebound already. So this is where we are right now, you know. We're roughly around, you know, May, and we're already almost back up to 2019 levels. So what does that tell us? That tells us that, hey, you know, we had a dip, and, you know, because the states shut down, and now some of the states are starting to open up, things are starting relaxing. People are starting to get out there and buy homes again. Okay, so the housing market is actually still relatively pretty good. We had a slowdown in showings, but we're starting to rebound really quickly. Okay. And then I want to go through some other slides too, and all these will tie in together to what I'm trying to explain here in a little bit. So the next thing I want to show you is one of the tools that us real estate agents have access to in the Twin Cities here. If you are part of the National Association of Realtor, this tool is called InfoSparks, and what it does is it just collects a whole bunch of data from our MLS about home sales. Okay, so right now I want to show you guys where median home prices are. Okay. So this graph actually goes back to 2005. So if we look at 2005 at the height, you know, at the height of that market, we're sitting at about 230,000 as the median sales price for properties in the Twin Cities region. Okay, and then at the bottom of the crash, you know, we're sitting at about 150. But look at the graph; it's steadily increasing. Okay, and if we look at 2020. So if we go to January 2020, we're sitting at about 280,000. So we're already at the beginning of the year, we're 50 grand over what we were at the height of the last market, you know? So what does that tell us? Prices are going up. Prices are more expensive than back then. So you can expect to pay more. But then what about the last few months? What's been happening the last few months, right? Okay. If we look at it, if we look from January to March, okay, March, you know, it went up 283,000. Okay. And what about right now in April? We went up to 285,000. So people are asking me, well, you know, there's coronavirus out there. People are not buying houses. Why are house prices going up? Why shouldn't they be going down? You know? Well, the other thing too is the amount of inventory that we have in the market. Okay. So I want you to look at this. This is called the month supply. And what month supply is pretty much how much inventory do we have in our market right now. If we stop listing houses for sale today in the Twin Cities region, how long can we go before there's no more houses for sale? And again, back at the height of the market crash in 2008, you know, we're seeing at about 10 months. Okay. So example, if we stop putting houses for sale today, within 10 months, there'd be no more houses for sale. Average, we should be at around 4 to 6 months of inventory. But let's look at right now, okay? Right now, April 2020, we're sitting at 2.2 month inventory. So that means within within 2 months, there'd be no more houses for sale in the Twin Cities region if we stop listing homes for sale, okay? So what does that tell us? Prices are more going up, and you know, the inventory is very low, okay? Now, how that ties into, you know, the home prices, and we're seeing multiple offer on people going out and buying homes right now. The reason for that is because even though a lot of buyers have been shut out of the market, Ying, can we go back to the PowerPoint?
Sure.
The reason why people are still seeing multiple offer situations, prices are still increasing, is because a few months ago to last year, we had a lot of buyers, and I mean a lot. Okay, and even with the recent changes that have been going on with the market, you know, what it's done is the inventory has not changed that much. If you remember back to that slide I showed you, you know, we've been sitting at around 2 to 3 months worth of inventory. Okay, so the inventory hasn't changed that much. The amount of buyers has changed, but not significantly. Okay, Right now, the purchase requirements have changed a little bit for when you go and get a pre-approval to purchase a home. The major change that people are seeing is the credit score change. That's what most people are talking about. And, you know, we hear like JP Morgan Chase just increased their credit score requirement to purchase a home, you know, and FHA is a little higher. Lenders are increasing all of their credit requirements. Well, yes, they are. But in the grand scheme of things, they haven't changed that much, okay? Maybe they've gone up 20 points, you know? But even so, going up 20, that knocks out a lot of the people that qualified at the lower level. So those buyers are knocked out of the game, but still there's a whole bunch of buyers that are left over that are still strong enough to buy, okay? So that's the reason why we're still seeing multiple offers. And now that all the buyers that are strong are out there looking for houses, of course, you know, you're not going to be going up if you're purchasing a home. If you're a buyer and you're putting in an offer on a house and that property has multiple offers, likely you're going up against other buyers that are strong as well, you see? So they eliminated pretty much a lot of the tire kickers. But there's still a lot of serious buyers out there, okay? So these are some of the purchase requirements right now to get a pre-approval to purchase a home, you know. Generally, you know, you're looking at a FICO score around 640 to 680 to qualify for a mortgage. You know, and these are just general numbers. There's a whole bunch of different type of loan products out there, and they have their own loan criteria, their own credit score criteria. So these are just in general. 640 will be tough for you to get a loan right now, but it's still doable. You might have to come up with some down payments depending on the loan again. 680 will put you kind of in a sweet spot to be able to get a loan a little bit more, you know, easier. And if you're 700 and above, then you'll have a lot of different options out there. Just because, like I said, banks, they want to see people that, you know, are going to have a better chance of repaying the loan. Okay, so that's how they judge you, is based off of your credit score. So the major changes are going to be around credit score. There's little changes here and there too, but most of the changes that we've been seeing is around credit score. Now, other things that you'll need to when you want to buy a home is you'll need 2 years of taxes. And the reason why they ask for 2 years of taxes is because they're looking for work history, and they want to make sure they don't have any long gaps in employment, okay? The thing with that is a lot of people get confused. They think that, okay, I have to work 2 years at the exact same job at the exact same position. That's not the case. So you can work multiple jobs as long as you don't have a long break in employment. So say example, you're working at ABC company and you get an offer at XYZ company, pays more, and you take, you know, you quit this job and then you go right to the next company. That's fine. That's okay. You know, they just don't want to see you taking a 3-month, 6-month, 12-month break in between that. Okay. And that's what they're trying to do. Another cool little trick too is it doesn't always have to be just, you know, work employment. So schooling could sometimes count as could satisfy the work history requirement as well. So I know, like for us, we deal a lot with minorities and things like that. So we've helped people where they don't have all of the required work history there, but let's say, you know, they were taking ESL classes or they were in high school, you know, that works. You know, it depends on the lender again. So you have to ask the lender and what their underwriting criteria is, but you know, there's all these different ways that we can, you know, try to help the borrower come up with that two-year work history requirement. And then they want to see your 2 most recent pay stubs. The reason for that is sometimes a lot of borrowers, you know, they'll say they work full-time, but this week they get 40 hours. Next week they get 35 hours. The week after that they get 42 hours. So they just want to see that your pay is consistent. I see this a lot, like I said, working with minority groups and stuff. One type of job that's really popular in Minnesota here, and I was assuming around the country, is PCAs, personal care assistants. Their times always fluctuate. So that's the reason why they want to see those 2 most recent bank pay stubs as well. And then the last one, you know, they'll usually ask you for is 2 months of the bank statements. And the reason for that is because they want to make sure that whatever money that you're planning to use to purchase the home is actually your money. So they don't want you to go, say, example of the down payment is $3,000. They don't want you to go borrow $3,000 today, put it in your bank account and say, hey, I got $3,000 I want to use. Because now that's pretty much another loan that you'll have to pay. So they have to calculate that into your debt to income ratio. So that's the reason why they require 2 months, because they figure that if the money has been in there for 2 months, then it has to be your money. There are some, you know, rules around that. Well, you know, and like I said, depending on underwriting criteria of the lenders, there's different things that we can do to help you satisfy that. So generally, you know, the purchase requirements to buy a home hasn't changed that much, besides, you know, the credit score. So, you know, I would say if you're in the market to purchase a property, don't be so scared, you know, reach out to a lender, reach out to myself, or, you know, to a real estate professional to see if it is time. And what I always tell people is there's never a right time to buy. There's never a bad time to buy either. It's always when you are ready. That's the best time to buy. Okay. So, you know, I want to turn it over a little bit to Yang to see if she has any insights on you know, the tax side of residential as well.
Sure, related to COVID-19, right? And I can tell you that COVID-19 put a lot of workers to home. So they start to work from home. Can you imagine you stuck in the small apartment, work from home? That would not even be comfortable. So, you know, I think the home need goes up is very understandable, because more and more home space is needed for home office. So that brought you a new tax tips that you should remember: home office deduction. If you work from home for your employer, you should explore that. If you work from home for your own business, you should deduct that, right? You should know how that works. And also, now you're at home listening and logging in for this webinar. And didn't you just bought a big screen TV to do that? What kind of IT technology investment you just did? That would be a investment, that would be a deduction for your tax saving. Once you have a home office, you have something what we call the mileage deduction. Because if you work for a company, say you work at a home care place, and you go home and you do your homework, you do your work at home for the paperwork side of work, and then when you drive there to work, that become a deductible mileage. But if you don't have a home office, you can't deduct the mileage. That is called commute. So home office deduction bring you mileage deduction. And what if you bought a smaller home, and then later on you decided to build an extension, build a addition? That addition is nothing but your beautiful home office. So that is deductible again. And know that when you sell your old home, buying a new one, your old one, the capital gain is tax-free. There is no taxes to it. And you're gonna ask me, oh, how much is my capital gain can be free? If you bought a house for $1, you sell for $250,000 and on your own without your spouse, then that is totally free. You don't have any gain, even though your house was just $1. You sold for $250,000. Okay, so that's how much of a tax can be free. And then you talk about the existing home, you can leveraging that on equity. Maybe you can borrow out of the home and buy a commercial property. This is where leading into David to talk about commercial market, not just residential. How is COVID-19 brought the difference to the commercial market? David, can you please elaborate that?
Yeah. So this is, like I said, this is actually my area of expertise here. Yang brings up a good point about leveraging. You know, us as business owners and a lot of us as professionals here, what we want to do is we want to leverage that. Leveraging, not just, you know, real estate, but any type of leverage helps us increase our business a lot faster than if we, you know, went and did everything ourselves or funded everything ourselves. So leveraging is always a good key to understand. Okay. But speaking specifically about investment properties, okay, you know, there's a lot of different type of investment properties out there. I'm just going to stick to two main ones, such as rental properties and flipping, and what's going on right now with those. So generally looking at it right now, you know, residential rental properties. So what residential rental properties are they are 1 unit to 4 unit properties. Okay, those are considered residential rental.
Mhm.
Above a 5 unit would be considered commercial rental property. So that's just one thing for you to understand. Okay, but right now, market, landlords are still struggling to collect. Okay, I don't know, you know, if any of the viewers here today are landlords, but a lot of landlords out there, you know, they're worried. You know, when the coronavirus started picking up here in the United States, a lot of landlords were scared. You know, and they should have been, because you know, right now as it sits, we're almost at 40 million unemployed people in the United States, and I'm pretty sure that number is a lot higher for the people that didn't even file for unemployment. So, you know, a lot of people are worried how are they going to make rent, and then landlords are worried how are they going to afford their mortgage. Luckily, you know, the government has been able to step in and help out a little bit. So, you know, there's still a lot of anxiety going on in the market right now as far as landlords and tenants. But if, you know, some of these companies out there that do gathering data to see, you know, how many tenants have paid their rent. Actually, if we look at it, most tenants have paid their rent. Have they paid it late? Probably, you know, most likely. We haven't seen a lot of tenants pay on time recently. So generally, like I said, each state is a little different and each lease is different. But generally, you know, especially here in Minnesota, and how I practice, even for my rental properties, is rent is usually due on the 1st and payable by the 5th. You know, we're starting to see a lot more rents that are paid after the 5th, but most of them do get paid. Okay, so as of right now, the balance between renters and landlords paying rent and paying mortgage, it's okay. How long that's going to go on, we don't know, you know, because we don't know if the economy is going to recover as quickly as people are saying, or if we're going to slide into a major recession, depression, that could affect it down the roads too. So we're not sure. All we know is right now, things are okay, you know. But then again, with that said, there is still a lot of tenants that have not paid the rent, okay? And a lot of landlords around the country are not able to evict them because they put halt on evictions, okay? So we don't know if there's going to be any law or any type of help to address that once those halts on those evictions are lifted, okay? So the reason why I bring that up is because if there is nothing, if there's no backstop to help people, and there's a flood of evictions that happen, that for sure is going to hit the real estate investment market, okay? Like I said, these are just my predictions, but you know, if that does happen, you know, the market could come crashing down, you know, property values could come down, you know, there could be a lot of foreclosures going on. And like I said, it's all just a prediction. We don't know, we don't have a crystal ball of what's gonna happen. But if I was in a position, if I was a landlord or a real estate investor, I would be positioning myself to be ready for that, just in case that happens, because that does happen. There's a lot of good deals that could be coming around, okay? And you gotta kind of have to understand what's going on right now. Yes, there's the health aspect of it, people getting sick and yada yada yada, but the economic aspect of it, you know, it's just cash changing hands from one side to another. Where's the cash flowing to? So obviously, you know, the cash is going to be flowing, you know, back to more to investors if the market crashes. That's the reason why they don't even really call it a crash. They call it a market correction. Okay, so that's really what will be happening. I would say in the next few years here, because the market, it doesn't always follow the economy. So if you look back in 2008, 2009-ish, that's when the crash happened, the economy crash happened. But the market correction delayed. So we didn't see the bottom until around 2010 to 2012. Okay. So, are we going to have the same delay here? I don't know. Is it going to be a lot shorter? Could be, depending, because we never had this type of situation before. So as an investor, you want to be cognizant of all these different forces that have a play in how the market is. But as we look at it today, in today's market, property values are still very strong. Just like what I showed you earlier in the values of homes, okay? Especially for residential rental properties, the 1 to 4 unit properties, they're valued almost the same way as a single family home is valued. They're valued based off on the other values of the homes that have sold around it, okay? Now that's a little bit different than commercial. Commercial is more based off value of the how much that commercial property produced. So commercial is in a whole nother realm. That's that 5 unit and up, warehouses, office spaces, things like that, okay? But speaking strictly on residential rental properties, property values are up, So a lot of homeowners or a lot of landlords or investors, they want to refinance and probably take some of that money out. One thing you have to understand is right now, though, with everything tightening up, banks are a little bit shaky. Especially, they're getting hit from the government having to, take on all these different loan products and everything like that. Refis are taking a little longer, And another reason to that too is because interest rates are at an all-time low. So they're having a flood of people, regular homeowners, not just investors, wanting to refinance their home and take some cash out. So you have to understand that refinances are going to be a little longer in their process, okay? I had a few buddies of mine, they're refinancing their properties. They called me and they say, hey, does it usually take 2 to 3, 4 months? I'm like, right now it could take that long because, they might have a backlog of people that are putting in applications, but not just that, they're going to be a little bit more stringent on the refinances as well, okay? Now, there's another thing that people are really, looking into as well, and it's called the home equity line of credit, or a HELOC. And there's some uncertainty in that right now, okay, in that market right now. And what a HELOC is essentially, it's almost the same as a refinance. But what it is it's a line of credit. So think like credit card, a line of credit that's attached to the equity of your home. So say example, if you have $50,000 equity in your home and you want to tap into that, but you don't want to do a full refinance, then you can just get a home equity line of credit, attach it to that $50,000, and now you have a revolving line of credit. So if you use $100 of that 50,000, then you have the over balance, and once you pay the $100 back, then your balance is back to 50,000. So that's what a home equity line of credit. Where the uncertainty is that people that already have home equity line of credits, generally, they have stipulations in their loan documents saying that the lender has the ability to adjust the terms depending on what the value of the home is. So if values change dramatically in the next few years, lending can change those terms. And like I said, if you have a home equity line of credit, I would suggest you go back and read the terms of your loan just to make sure you understand if there is any sort of clause like that in there, and that way you can prepare for it, because you don't want to have $100,000 equity line of credit, home equity line of credit, and then you're waiting to buy another investment property when the market crashes. But since the market crashed, the home equity line of credit that the property was attached has also decreased. So you don't want to get blindsided by that, okay? I know I heard that like Wells Fargo, they're starting to be a little bit more strict on that and look at that too. And home equity line of credits, they usually have an expiration date. They could be like 5-year, 10-year, 15-year, 20 years. So again, like I said, really look at your loan documents and make sure you understand what is in there, okay? So another thing that goes with property values is, since property values are high, I'm seeing a lot of investors that want to sell their properties, but they don't want to pay capital gains. Because, if you had a property for a long time and you are going to make a big chunk of change, you don't want to give all that to Uncle Sam. You might as well put that somewhere to better use. So, a good option for people is 1031 exchanges. Okay. And what 1031 exchange is pretty much you're delaying the paying of the capital gains on the purchase of your current or on the sale of your current property until the sale of the next property. Okay. A lot of investors, they have strategy because they can just keep 1031 exchanging, every single property and keep moving up and up and up and up. So that way they can just delay that. That's a very good strategy to, not pay capital gains or delay paying capital gains. And Yang can elaborate on that a little bit more. But I just want to finish off with what I was saying that 1031 exchanges, the reason why I bring that up is because there has been a little bit of change to the rules. Generally, you have 45 days to identify the property, and then you have 180 days to actually purchase the property, okay? And then I had a lot of calls from my clients, from other investors saying, hey, how does that affect me, especially if the 1031 exchange companies and the intermediaries, are all working from home or their companies are closed down and I'm in the middle of this identifying a property, or I'm in the middle of the 180 days, how does that affect me? Well, in the last few laws that they've just passed, they've made some changes to the requirements for 1031 exchanges. Ying, do you want to cover that a little bit?
Sure, that changes all the way to July 15. So let's say if your 45 days landed now you have it extended to July 15. So it's a general extension all the way to July 15 as our tax due date stipulates.
Okay, yeah. So that will have an effect on you if you are in the current process of trying to do a 1031 exchange. Okay, so again, if that's what you want to do, you want to sell your property, buy another property, and roll it over at this time. Like I said, house value, property values are up, so it might be a good option to do, but just be sure that you're keep an eye on the different rules that come out with that. Okay. Now, purchase requirements. If you are purchasing a residential, again, the 1 unit to 4 unit property, and if you're using it as a owner occupied building, so say example, you live in 1 unit and you rent out the other units, the purchase requirements for getting a home loan, it's exactly the same as buying a single family home. So no difference there. Low down payment, low interest rates. It's a good way to get into rental properties and test it out if you want to test out being a landlord. But if you just want to purchase a property outright and rent it outright, you're not planning to live there or anything, you're going to be looking at 15 to 20% down. And that's depending on the lender that you go to. Like I said, some lenders are 15. I've seen some lenders high as 30% down. So you shop around. Generally, what I tell people, a little tip is, go to the smaller banks or go to the smaller credit unions. A lot of them are what we call portfolio lenders. They lend their own money. They keep the loan in-house in their portfolio, so they're a little bit more lenient on their loan guidelines, and they might allow lower down payment as well. So that's one of the things. If you go one of the big chains, then it might be harder to negotiate with them. But I think there's whole bunch of tax benefits to investing, not just right now, but going forward as well. And I think, I would love to hear what Ying has to say more about that.
Yeah, on the commercial side is really a lot of things to consider, but I picked 3 very important ones to elaborate. And I know David already mentioned a lot about like-kind exchange. Just think of, to use a very simple example is, let's say you bought a commercial property for $1 and you are selling it for $250,000 again, okay? Normally, because it's a commercial property, remember that home exemption doesn't exist, so you will pay capital gain for the $250,000, okay? And like-kind exchange says, don't pay the taxes for $250,000. You can use the $250,000 to buy a building that is $250,000. So you take this $250,000, bought another building much bigger and much nicer for $250,000. and you don't pay taxes, you only pay capital gain when you sell that building. So let's say 5 years later, you sold your 250,000 building to 500,000. At that time, your capital gain is not just half of that. It is going to calculate from the first dollar you deferred. So like-kind exchange is for you to exchange properties, only properties. This rule has been updated since December 2017. In the past, we can like-kind exchange a lot of things. For example, life insurance policy, and we can exchange art and virtual currencies, things like that. But now, since December 17, it got narrowed down to just real property. So you want to make sure that you know if you have a real property and now is a good time to buy, it's also a good time to sell. Maybe you should utilize like-kind exchange. And in this whole complex rules, I will make you an expert if you just remember two numbers, 45 and 180. I know COVID-19 kind of changed the number, but it's not going to be here forever, COVID-19. So that like-kind exchange and that rule, the 55 days to fix your mind, what I mean by that is when you sold your $1 property, you want to identify another one to fix your mind on something that need to be done within 45 days. And then 180 days to complete the transaction just means that once you identify that property, you need to close that whole deal, make that building yours within 180 days. So as long as those requirements are met, you literally has a ticket to get the tax payment for free. What happened to your tax return is you will file your building got sold. You will identify capital gain for 250,000. You will check on those 55 days met, 180 days met, and then the great computer that the tax preparer has at their office will automatically make that gain to be a non-taxable deferred tax gain. So you do pay taxes eventually, but you get that deferred. So that's like-kind exchange. I really hope that I kind of make you feel like, oh wow, I got it, Ying, and I understand. Second concept related to commercial property purchase. Say you bought that 250,000 and you bought 250,000 building. Don't go to some places. They tell you you have to depreciate for 39.5 years. Absolutely not. You're gonna say, well, I am a very smart businessman. I know there's a thing called cost segregation. And I want you to notice this form I show you. Before cost segregation, the same building only can depreciate 30,769. Did you see that? It's right here underneath 30,769. This is what your tax preparer often do. What they do is they take your building value, they do your 29 years, they give you very little to depreciate. But if you do cost segregation, then you can deduct 50,376. It's almost double, okay? So I want you to not take it lightly. And if you bought a building in 2020, and if your tax preparer don't know what is cost segregation, is really need to be careful because you lose that chance, you lose forever. It is not something like next year you come around to Community CPA and we can change it. No, unless we amend your return, which is not a good idea. Okay, so that is the second concept related to commercial building purchase. Then the third concept I want to give you, it is new from CARES Act called speed up depreciation. What happened is, let's say you bought that building, but you have to spend $100,000 to renovate it, make it ready. So $250,000 building become $350,000. Am I right? So now the CARES Act said, just in case you didn't do it in 2020, you did it in 2019, and you didn't take advantage of a speed up deduction because it was not there. And the CARES Act allow you to amend your tax return or fill up a form called 3115. Just write it down or take a snap picture of this screen. This is what you need to take to the tax preparer. If you tell me that you bought a building and you did not take advantage of CARES Act, and you are doing it wrong, okay? With that, what you can do is you can depreciate that building in 15 years instead of 39. Got it? So this is a very special rule that came out, and all of us are so busy with PPP and with disaster loans. So I know your accountant is busy, but the CARES Act related to the year-end planning will come in, and I want you to think about it when you start engaging David for purchase of commercial properties. You need to know that you think of like-kind exchange, you think of cost segregation, you think of what CARES Act give you to take advantage of. Okay, so with that, I want David to go to our third element in this webinar, which is to become a real estate professional. And with that, I also have a bunch of tax advantages to give you so you can be smart to be a business person. David, go ahead. Let's explain what is this all about.
Yes. All right. So this slide right here, pretty much what we're going to be talking about is if you are a real professional, if you're currently a real estate professional, such as a real estate agent or broker, or if you are thinking about becoming one, there's resources to help you in your current business and to set up a business. Okay. Right now, the National Association of Realtors, that's the association that kind of oversees all realtors. They put out a lot of free resources to help us realtors. One thing I want people to understand too is there's a confusion out there between who's a realtor and who's a real estate agent. Okay. So a real estate agent is somebody that has a real estate license. They're licensed in their state to be able to conduct real estate transactions. That's a real estate agent, okay? A realtor is actually a member of the National Association of Realtors, okay? And there's a few different associations that you become part of once you become part of the National Association of Realtors. So there's NAR, again, the National Association. There's, especially here in Minnesota, and throughout most states, they have their own state association. So we have Minnesota Realtors, that's our state association. And then you'll have also a local association also. So like for me here, we're part of the St. Paul Area Association of Realtors. So all of those different associations have resources for us to be able to help us run our businesses safely and give us guidelines on what to do now. And also they have other benefits too to help us get through this. Like with NAR, for example, if you are a member with them, you have access to their telehealth network system. That's for healthcare. You're able to do free classes on the sites that they provide or at a reduced cost. So if you are and you're struggling in those areas and you need some help, I would definitely reach out to them. I put their information here on the slide for you. It's just nar.realtor. You can get access to those. And again, like I said, your state association will have resources, and your local association will have resources as well. Okay. And the good thing about most real estate professionals, such as real estate agents and brokers, most of us are self-employed individuals. Okay. So again, the National Association of Realtors, one of their jobs is to go out and to lobby Congress for us. So back when a few months ago, when this was when the COVID-19 thing was going on, and Congress was sitting there trying to come up with a stimulus bill of how to help the economy, help all the people. NAR was there, the National Association of Realtors was there trying to fight for us. So most states right now are able to implement a self-employed unemployment insurance. So like I said, you want to check with your state, whatever state that you're in, but here in Minnesota, it's uimn.org. Go there, apply, and check to see if you qualify for self-employed unemployment insurance. Okay, and Ying can go through these, and I know that Ying has been providing a lot of resources on these too. So if you have questions about these, make sure to reach out to her. She's like the expert at all this stuff. So other types of things that are out there to help you. You know, you might qualify for SBA loans. There's a lot of economic injury disaster loans out there, and not just that, but SBA has multiple other types of loans as well too. So if you're just starting, or if you've been impacted by what's going on, reach out to the SBA, you know, and see if you can qualify for any of those types of loans to help you out with your business. Another popular one right now is the PPP loan. I know that there is some restrictions on it of, like, you know, timeline of when you can file or how much money they have or things like that. So you want to check with the SBA again, or your preferred local lender. It's usually, you know, you apply through your local lender that works with the SBA to get the PPP loan, which is the Paycheck Protection Program. So again, they put rules in there that allow self-employed individual to be able to have access to these different types of loan products to help us get through these times. Okay. And the last thing that I truly believe is that, you know, there's many benefits to being classified as a real estate professional. And Yang will talk about this a little bit more, but I just kind of want to give you my spiel on it. You know, right now has never been a better time to become a real estate professional, whether that be a landlord, a house flipper, a real estate agent, a real estate broker. Right now is a great time to do that. And in our company, we actually train people how to do all of that. So, you know, if you're thinking about it, give us a shout out. But again, the reason why I say that is because I think the tax code and real estate were made for each other. You know, take example all the laws that were just recently passed. A lot of them were benefits to real estate investors. You know, as Yang will point out in a little bit. Obviously, yes, we saw the front side of that. The front side was, hey, you know, a lot of people are getting $1,200 and all that stuff. But you know, I hate it because, you know, in that big stack of laws, you know, a lot of that benefit went to businesses, real estate investors, and things like that. So, you know, you as a business person, as a real estate person, I want you to be able to take advantage of that as well. Okay. And like I said, one thing that, you know, being a real estate professional does is, you know, it allows you to be in a type of career field or in a type of business that gives you the maximum amount of tax benefit. At least that's what I think. But yeah, I mean, Yang, can you elaborate a little bit more on the real estate professionals?
That is so true. That is so true. And right now, the tax code is in favor of real estate professionals. And just like David pointed out, it is not necessarily just the people who have license for buying and selling home. Real estate professionals are the professional developers and the people who are in real estate business. And I want to ask you, and I know that most of the people who attend today's webinar are business people. Maybe you're interested in real estate, wanting to be an agent, or maybe you are already doing home flipping and all kind of things. My question to you is, did you apply for PPP loan? And that loan can be forgiven, right? So I don't know whether you have done that or not. This is one of the benefits to be a business person and to be a real estate professional. If you are an agent, you also qualify for that 2.5 times your monthly payroll. If you don't have a payroll, you just have a distribution and you're LLC, you also qualify for that. So I want to point that out to you so you know that, see, there's maybe something I haven't really done and I should do. And the PPP is still open. And as a business person, it's not all about, oh, I am a business person, so I show up as I did my business. Business person also need to be very calculating. Right now, it is time for you to look at your cash flow, and the government assistance is another way to gain your cash flow. Maybe you can get the economic injury disaster loan, the SBA loan. That could help you pay off the high interest property you have and get into the low interest, 3.75%, 30 years, first 12 months, and there's no interest, no payment. Why not, right? So with all of that, it's pointing to a fact to say that becoming a business owner, and when you are a real estate agent, and when you work with brokerage firm like Home Sellers Inc., you become a real estate agent. And that is a tattoo for businessmen and women. And you can look at your business conduct, decide whether you want to be a sole proprietor or you want to be an LLC member, single member, and or you want to be a 1120S and S corporation, and or even a C corporation. All of these structures is the answers for the best use of tax structure. Those require you to have that inquisitive mind. You need to ask that question. If you don't ask question, you will never get the right answer. A period, you don't even get an answer. Why would you get a right answer? Am I right? So you want to make sure that you ask question. And here, when you are real estate professionals, you have the opportunity to deduct business expense. And earlier in one of my slides, and with related to the home office, I have a home garden listed there. I noticed that I didn't go there, and I have participants is wondering, why do you have that listed? And let me tell you, there was a story about that. The lady bought a home, and older lady bought a home, and he took away all the grasses in the backyard. He turned the backyard into a experimental vegetable garden. So every year there are things coming in there, so he grow and he sell them. He didn't really sell. He actually leave them on the roadside for people to pick up because there were too many tomatoes or whatever. Over the years, people start getting to know that she does those things and people are coming around. So then later on, it's become a basket of cash, saying that you take my tomatoes and put some money in there. And then the last 3 years, it turned into a little community garden thing. So she's actually selling the product that she has, the seeds that she got out of the garden. Then the neighborhood and start planting that. With that, she started a business. So now it's a home she purchased, but her backyard become a business, become a little field, becomes a little farming garden business. So we have incorporated that business, and she now can deduct almost $10,000 a year on the soil improvement, on seeds and things like that. But in the past, it was money thrown away and no deduction, no tax efficiency, and no savings. But now look, she can reduce taxes by deducting the $10,000 expenses she would otherwise cannot deduct. So this is where I draw a point to you by saying, when you have a business, you have a business expense to come with it. That is just a one small benefit for being a business owner. The reason I say small benefit, because we have a large disadvantage. I'm just kidding. You have a responsibility, right? Yeah, when you are a business owner, you're not just self-employed. You have your employees to take care of. They're like your kids. They're like your family. And that responsibility is huge. Sometimes I'm looking at that responsibility and looking at the business owner side of benefit. I'm not sure I draw a equal sign or I should draw a this way sign, right? Utilize different tax structure. I just mentioned that. And I want to plug into my book. I wrote this book called Start Up a Business. And in that book, I have a chapter called Do You Need a Partner? On page 112, I talk about as a real estate professional, how you look for partner. A lot of times, if we're young and we have strength, and we're looking for partner with capitals, right? When you are in real estate business, you're a real estate professional, and you really are not looking for someone who comes in to really share everything you got. You're looking for someone who invested in your business, and when you make it, you give less a portion of that to the investor because you're the one sweating, you're the one doing things. So you have a bigger portion of a profit. So in this setting, and an LLC would be the best because you make the person who put in the money as a passive investor, so he doesn't have any risk in the business, and you being the active partner, and you will be able to deduct all your business expenses, and you will be able to pay yourself. You'll be able to take home a K1, and you can take 90% profit, and he take 10. And if there is a loss, because you don't have a lot to offset, you could literally make a partnership agreement, have 90% of loss goes to this rich person, and you take a little less. You know what that does to you? That make your financial statement look really good, so you can continue leverage with the bank. You can have an attractive financial statement to show them that you're doing a viable and good business. So a lot of tax benefit is really not enough time to cover it all, but I want you to know that as long as you have the imagination, and there's a way to get there. There's an old saying by there's a will, there's a way, right? So you will get there by thinking about it. And we are actually right at an